Mr. Schock.
Well, actually, ironically, Mr. Larson asked my question.
Oh, boy.
So I would like to use my time to follow up on that. And once again, the formalities, I appreciate you calling this hearing. I hope it's the first of many. And I, too, Mr. Larson, have enjoyed working with you on the financial products issues, but specifically the rough draft that we're going over now. And I specifically am interested in the put-call scenario you were brought up earlier, Mr. Rosenthal. So please continue with your answer.
I've used a lot of minutes. I'd like to share some with my colleagues.
Very nice of you. You get extra points.
But I'm happy. If you like, I don't mean to stand you up here, but I feel guilty that I.
No, you can provide additional information in writing. We'll hear from Mr. Gerlach.
I would agree that using a sort of an expanded hedging approach is a better way to deal with the covered call and the use of puts than marking both positions to market and treating them as ordinary. I also think that as the legislation moves forward, serious consideration needs to be given to the effect of, in effect, marking to market built-in gains on stock positions. That would be a big expansion of the constructive sale rules that Congress enacted back in 1997, and it might be a good or a bad thing, but I don't think it's been given adequate discussion so far.
If you have ideas, please forward them. Mr. Paul?
Well, I would agree that the idea that I don't think that the legislation intended to have this consequence on protective put options and covered call writing. I think the drafters were sort of forced to address them given the threshold decision to mark all derivatives to market as ordinary. I think the suggestion that's been floating around of expanding the business hedging rules, which are quite sensible and seek to achieve clear reflection of income, to at least some form of investment hedges, which are currently taxed under the straddle rules and are basically anti-taxpayer, I think that would be a huge step forward if we could do that. It's not easy. All the stuff we're talking about doing is not easy. I think there would be other unintended consequences in terms of valuation of instruments, particularly non-traded instruments, and have concerns that people there'll be tax planning at year end to enter into a derivative and then get a valuation that gives you a quick loss. And we can get into that more detail on that if you'd like.
Mr. Travis?
Thank you. I want to echo Ms. Hammer's point that there are unintended consequences of current law, perhaps more than there will be of this, and we may be able to spend our time better working here than trying to perfect current law. I think that's a very good point. Just want to mention one example that we've thought about, not exactly covered calls or puts. Let's take a portfolio of municipal bonds that produce tax-exempt interest. And there may be 1,000, 500, 1,000, there may be a lot of them that you hold in a large fund. And you may be looking at the financial properties of your portfolio overall and thinking about where those bonds in the aggregate position the fund on the interest rate curve, and maybe it's in slightly the wrong spot. And so you want to use a Treasury future contract to adjust where on the interest rate curve all of the bonds in the aggregate are. It would seem that the draft as written would cause you to mark to market the entire portfolio and treat what was tax-exempt income as taxable income. I don't think that's intended. I think it would be addressed by the hedging rule, but I think we would all be happy to work with you identifying situations like this and make sure that they are addressed appropriately going forward.
Okay, thank you.
Mr. Young, you're recognized.